We'll focus on a few topics and try to bring the story of Frits and Dick together more from a financial point of view. And I will cover it in 5 different sections. First of all, I will go a bit into the strong fundamentals we have to create value and give you a bit of highlights on that. Then I will elaborate on our strong, stable and long-term cash flows because our portfolio is changing over time. Then we'll focus a bit on the investment opportunities. So how do we come from the vision which is explained and where we have the capabilities for to execution and how would that work from a financial point of view. After that, I will focus on the capital allocation strategy we have as a company, just to reconfirm what we have. But it's important for you, obviously, to know what our strategy is there. And then last but not least, I would like to also highlight the strong long-term fundamentals we have as a company. Let me start on the value creation side. Why are the fundamentals strong? Well, first of all, on the left-hand side, you see the EBITDA performance. So 17% increase in the last 2 years with an outlook of around 970 million for the year. In connection with the EBITDA is obviously the EBITDA margin. We like to protect, maintain, and preferably improve our EBITDA margin going forward, and I will tell a bit on that later during the presentation, but we are increasing our EBITDA margin. Obviously, this financial performance is very strongly driven by our occupancy rate, which went up 3%, proportional occupancy, if you take all the economical interests we have in all our different companies. And we're now running at 91% occupancy. We always give a sort of guidance to the market that somewhere between 85 and 95, that's where you may find our occupancy. And obviously 85 is at a very lower end and 95 is the full potential of the company. On operating cash return, which we introduced 1.5 years ago during the Capital Markets Day, we are improving. As Dick already highlighted, the passion for cash is really there in the company. And we have increased to 14.4% year to date, which is a 3% increase over the last 2 years. Our long-term target is to be above 12%, also in circumstances which are maybe less favorable for us. And we have an outlook for this year to at least reach 13% cash return. Our total net debt to EBITDA, which was at the higher end 1.5 years ago or 2 years ago, was 3.16 times EBITDA. We have reduced it to 2.27, so quite a significant reduction in our debt, and it's below our ambition between 2.5 and 3 times. And if we look at the outlook for the year, we expect to land somewhere around 2.1. And if we do the Vopak transaction before the year end, we will probably drop below the 2 times EBITDA, which is historically quite a low number. So healthy from a value creation point of view. How does it look from a cash flow generation point of view across the portfolio? If I start again on the left-hand side, you see the proportional EBITDA, so all the EBITDAs we generate with all the activities we have, and we have broken it up for joint ventures and associates versus subsidiaries. And you see quite an increase from 2021 to 2023. So 749 million proportional EBITDA in 2021, now up to 872 million euros with an outlook of around 1160 million euros for the full year. And you see the breakdown between joint ventures and subsidiaries. So 41% of our proportional EBITDA comes out of joint ventures and 59% is subsidiary driven. If I then look at the middle graph, the proportional operating cash flow, which obviously is very important, has increased from 438 million to 615 million. As Dick already mentioned, we have generated quite a bit more cash flow, and this obviously is one of the key drivers. There you see a different breakdown in terms of joint ventures and subsidiaries. So close to 50% for each, which effectively means that operating capex in our subsidiaries is relatively higher compared to the EBITDA we generate in those companies versus what we see in joint ventures. And the real result of that is effectively that these joint venture companies are relatively more new than the subsidiaries we have as a company. So this is a difference in cash flow generation. And then on the third element on the right-hand side, Obviously, with so many joint ventures, it's very important to make sure that we have a healthy dividend upstreaming. You see that it increased quite a bit over the last years, 107% last year. Year to date, 103% of our net profit in joint ventures. Why is it even above the 100%? Because our ambition is to at least distribute 90% of the profits of our joint ventures to the holding company. We also sometimes have refinancings. So we did a refinancing last year in Fujairah. This year we did one refinancing in Pengerang, and it gives us the opportunity with these refinancings effectively to take some extra dividend out of the joint ventures. So in terms of cash flow generation, improving proportional EBITDA, improving operating cash flow, and improving dividend upstreaming. Then I would like to highlight a bit more on how does our cash flow generation look like versus, let's say, the ambitions we have, and also versus, let's say, the stakeholder distributions we have. And why is it relevant? It's relevant because I would like to show that we are actually quite self-sufficient in funding our ambitions. If you go to the left-hand side of this graph, you see that our cash flow from operations is 680 million, which is a split between joint venture dividends as well as group companies. Then obviously we need to pay taxes. We have cash flow from investments, financing, and we have also derivative movements, which can be quite significant. But if you deduct that from our CFFO, then you come to effectively the CFFO, which is available for certain activities. And the CFFO of 578 million, so the second gray bar, effectively can be used, first of all, to make sure that we maintain our assets in a proper manner. So approximately 27% year to date has gone into maintaining our assets. And for us, it's vital to make sure that we have high integrity of our assets, because the biggest risk for us as a company is that there will be a major accident at one of the facilities and we would, for example, put something on fire. So we want to make sure that our asset integrity is world-class. Then on the dividend distributions, you see that 28% of our cash flow has gone into dividend distributions, and this is the full year dividend. So this is only year to date cash flow versus full year dividend. So naturally, this percentage should drop if we bring in the fourth quarter cash into this overview. And then on growth CapEx, 22%, which is half of our ambition, the 150 million growth CapEx. We have set 2 billion for, let's say, a period 22 to 2030, so which is almost close to 300 million. So there is sufficient cash generated by the business to fund our growth CapEx as well. We had some divestments because of the portfolio rationalization, which so far has brought in 200 million, more to come with the Botlek sale. But that means effectively our changes in net debt means a reduction in debt and an improvement in our cash position. So going forward, obviously, it is very important for us to maintain this healthy cash flow overview to make sure that we are, to a large extent, self-sufficient and are not rapidly increasing our leverage as a company. If we break down the business performance into the different segments we have as a company, let me start first on the gas side. So what you see here is the proportional EBITDA year to date compared to the performance of last year. So a 10% increase on proportional EBITDA for the gas business. So the gas business was 166 million euros EBITDA for 2023 year to date. Well, the gas market is still favorable for us. The Gate terminal in Rotterdam runs in a very nice manner, driven by the energy security drive, an opportunity to also expand that facility. And the contract structure of our LNG portfolio is quite nice with 10 plus years of contracts. The second segment is on the industrial side. 175 million proportional EBITDA, minus 3% versus last year. Although throughputs are relatively stable, despite that the chemical market is maybe not very favorable at this moment in time, the real reason that this has dropped were some currency translation effects, and also we reduced our shareholding in Thai Tank Terminal, which is the industrial terminal we have in Thailand. We dropped from 49% to 35%. Contract structure for the industrial terminal portfolio is also quite long, 20 years plus contracts, so it gives us very stable performance. On the chemical side, the green bar, 272 million euros of proportional EBITDA, 17% increase over last year. Although the market is maybe not very favorable, last year we saw quite a bit of an uptick in the chemicals business. It's stabilizing at the moment, but where you still see quite a good performance is in Europe, because the European production centers are in a low utilization and a lot of chemicals are effectively being imported into this market. Contract structures are more between 2 and 5 years. Then on the oil side, a 12% increase year-on-year, 338 million proportional EBITDA, while the oil markets are very much dominated, you can read it every day, by volatility, quite some geopolitical pressure. People are rebalancing trade flows, but there is also security supply concerns. And with what's going on in the Middle East, these supply concerns may even accelerate going forward, but that overall supports the storage demand. Contract structures can be either very short term, can run up to 2 years, or maybe even beyond 2 years, but then we're more talking about fuel distribution terminals we have in different countries. And then the overhead, 79 million, headquarter cost, global IT, and some other overhead costs we have worldwide, 79 million, which leads in total to a year-to-date proportional EBITDA of 872. Then some highlights on the stable, strong, and long-term cash flows. As already mentioned, the 200 million improvement in cash flow really helps us from a return point of view, but it also helps us from a leverage point of view, and mainly driven by our business performance. So we have not compromised on operating CapEx, for example. We have made sure that we are focused on healthy dividend distributions, so more than 90% of our joint ventures. That is, as I said, our ambitions to upstream our dividends, and we have so far, during the year, reached more than 100%. Our growth CapEx to really invest it in attractive projects, and I will elaborate a bit on it later. Since June last year, we have invested 345 million euros in terms of accretive investments, and we have rationalized our portfolio with selling 8 activities in the last 2 years, which are bringing in quite some proceeds for the company as well. How well diversified is our contract portfolio and how well protected is our EBITDA margin? If you look at the EBITDA margin on the left-hand side, you see that compared to last year, we increased our EBITDA margin from 55% to 57%, and that's driven by good cost management, but also making sure that we have solid contracts with our customers. In the middle, you see the shift in contract duration, and it's taken over a longer period to see what the impact is. But the major impact, which you should take away from this middle graph, is the shift from shorter term contracts, the 1-year contracts, to the long-term contracts, which is more than 10 years. So in 2015, we had a quarter of our portfolio was effectively contracts less than a year. Now we have half that to 12%, less than a year. And if you look at the 10-year contracts, we're now at 34% versus 23%. So quite a shift, and it's all measured by proportional revenue, which is relevant for us as a company. And then on the right-hand side, which actions do we actually take to protect our EBITDA margin? Well, first of all, it starts with the customer contracts. So where can we factor in inflation correction clauses? And we have in more than 70% of our revenues can be corrected for inflation in different ways. So there is not one sort of golden rule on how we do it. It's different market by market. But if you want to have a bit of understanding, most of the gas and industrial business have quite good indexation clauses. Where it's much harder, for example, is in the hub oil market to have proper indexation clauses, because it's a much faster market and the contracts are much shorter. On the energy cost, we have quite an active hedging strategy for energy cost. So for the Netherlands and the US, we have hedged already 2024 50%. The other 50% is effectively what we pass on to our customers. And in Singapore, we have hedged already for 100%. So we want to make sure that we protect our margin there as well. And then obviously we have simplified our organization structure, which you may have seen, delayered it, took the division layer out of the organization, have reduced the number of FTEs in the organization with 50, and there will be a continuous focus on making sure that we run a very efficient and effective organizational structure to support our business. How is the portfolio moving over time? And also this is a bit of a longer journey from 2017 to 2023, but also a bit looking forward to 2030, so to give you an impression on what you may expect. And here we measure it for our proportional capital employed. So where have we really invested our capital in? If you go 5-6 years back, you see that 10 to 15% was effectively invested in gas and new energy. Well, new energy maybe at that time didn't even exist. 15 to 20% was industrial, and the biggest chunks were chemicals with 25-30% and oil 45-50%. If we go to today's portfolio, the major shift you see is effectively that we reduced oil quite a bit from a capital employed point of view. We increased on the industrial side and we increased on the gas side. And that journey, especially on the gas and new energy, will continue in the coming 7 years. That's what we expect. That will mean that oil will further reduce to 15-20%. It will mean that gas and new energy will grow to 35-40%. Industrial terminals, in terms of capital employed relative, will stay approximately the same, but overall our capital employed will grow due to the investments, and chemicals will be lower at 15-20%. So that's the trend you may expect. The investment we made over the last 18 months, as I said, have been 315 million in terms of equity contributions. But if you take our proportional capex, and that makes it a bit harder with all the joint ventures, we have invested over 560 million euros. Then the cash returns. Obviously, this is, we look at a lot in the company. If you go to the right-hand side, you see the overall cash return, which I just presented a few slides ago. If we break it up into the different terminal types, you see that on the industrial side, we increased in the last year from 16% return to 17.8% return. Quite a nice step up. Similar for gas, due to the improved performance, as I mentioned on the proportional EBITDA, we moved from 11.5 to 14.5. Oil has come up from 15% to over 20%. And chemicals, we have made quite a recovery. Last year we presented in Capital Markets Day that chemicals was at the lower end of the portfolio. Now it has increased from 10% last year to 16% this year. So quite a nice step up. What you don't see here, because if you would take the average of all these activities, you would not come to the 14.4, is obviously the impact of the overhead cost, which is approximately 1.5%. Our operating cash return for this year ambition is above 13%. Long term, it's above 12%, which means that if the market is less favorable for us, we still want to make that 12% return. Then how are we going to allocate capital to growth capex, and how interesting is it for us to invest in certain activities? If I could start at the left-hand side again on the return, what we've tried to do here is to show you the multiples, the EBITDA multiples of our investment portfolio. The growth pillar, which is really driving gas and industrial investments, we think that we can deliver that between 5 and 7 times EBITDA. So once it comes on stream, that should be the sort of EBITDA target we have in our portfolio. On new energy, so more related to the accelerate part of our portfolio, if it's really greenfield, we think that because of starting up these positions, because of growing these positions over time, it probably will come at 1 notch less EBITDA multiple, so between 6 and 8. That's what we expect, and that's what we see today in the portfolio. But still a lot of proof has to happen, of course, on whether we can land it within these multiples. And then repurposing our existing sites for whether it's for biofuels or any other products, we think that we can deliver that between 4 and 6 times. So that makes these kind of repurposing exercises quite attractive. Although you need to realize that once you repurpose a site, it will also temporarily lose, let's say, certain of the revenues. So the transition is not going without any impact for the company, that's for sure. In the middle, the allocation of the 1 billion euro in terms of the Accelerate, so the new energies and the sustainable feedstocks, 80 to 90% will go into infra-like investments. So effectively the activities we already do today, so expanding our terminal network. And 10 to 20%, as also Frits highlighted with the venture investments, will be invested in those activities where we aim for a return of 2 times money multiple, making sure that at least we have a few companies which hopefully are going to outperform, but certainly there will be failures in this portfolio as well. But our overall ambition is to really make our money twice in that portfolio. And then on the timing, we get a lot of questions. Okay, what is the timing of all these investments? It's nice to announce 2 times 1 billion, but when is it going to happen? Well, most of the investments in gas and industrial will definitely take place between 24 and 26. That's what we expect. It's a bit unclear what will happen after 2026, but it may have longer legs going forward, especially if you look at the chemicals demand in the world. And that would trigger then some industrial terminal investments. If you look at the Accelerate, the new energy, where we really expect that that is going to take off between 25 and 30. So a little bit more time has to be taken. But what we see already today is that there is quite strong momentum in the portfolio. On the other hand, what we also see today is that to really realize these projects, people are quite optimistic in the beginning, but the reality is that it takes a bit more time than people may think. Our disciplined capital allocation strategy, which we highlighted last year during Capital Markets Day, definitely on the first priority, we will focus on a strong balance sheet with a healthy leverage ratio between 2.5 and 3 times. We realize that we are dropping potentially below 2 times. Looking at our growth portfolio, obviously that will have some uptick, but with our strong cash flow generation, if that continues, as I said, we are quite self-sufficient. So we will look at opportunities to see how could we potentially distribute some additional money to our shareholders, but it's too early to conclude on this. So don't hold me on this comment, but we definitely go through a process to assess it. Second priority is to remain active with our progressive dividend policy. 130 we had last year, so definitely you will have a higher dividend next year, and obviously we want to grow that dividend over time. And then last but not least, and we see good opportunities, as I mentioned, to really invest in accretive growth projects between 4 and 8 times EBITDA multiple. And given the fact that, let's say, the leverage has come down quite a bit, there is more room to grow the company going forward without compromising on the balance sheet and without compromising on our progressive dividend policy. Maybe to recap on this slide, so there are strong long-term fundamentals for us as a company. We think that we are well positioned also from a financial point of view and from a financial performance point of view to capture the growth opportunities. First of all, obviously, we would like to deliver on our financial results. We have an asset portfolio which generates strong, stable, and long-term cash flows. We will continue to actively look at our portfolio. That's what we do as an executive board. Every quarter we go through our portfolio. Where is the performance improving? Where are we satisfied? Where are we not satisfied? We will always do this active portfolio management. We will create connections in the world with a well-diversified global portfolio, making sure that we have solid long-term contracts with our customers in place with the right clauses, and we will continuously looking at repurposing and expanding our current footprint. And last but not least, we obviously like to drive the progress, unlocking new opportunities. A lot has mentioned already, but to really allocate growth capital towards new opportunities at attractive multiples and making sure that at the same time we return value to our shareholders, that is where we stand for as a company. So that in a nutshell brings me to the end of, I think, the 3 presentations, and I would like to invite Dick and Frits